All right, going live, going live, going live. Let's get this live. We go. I don't know if we're live now or not, but if you're watching this on time delay, go forward into the future, like 1 minute. There'll also be a description down below on what's what as far as when this thing actually starts. There's gonna be actually a little delay. I'm gonna be late to my own meeting. So if you guys have questions about the housing market, feel free to ask them. Boom, let me edit. What's up, y'all? If y'all got a question about the housing market, let me know. I'm going to be live on YouTube in like 2 minutes. Actually, I'm live right now, but I'll be live on YouTube, kind of breaking down my thoughts on what's going on with the good old housing market. And so I'm actually running like slightly behind. I started this live a little bit too late. And so I'll probably start in about 2 minutes, starting in 2 minutes, your videos. And so I'm going to be talking about Fannie Mae housing market breakdown. Let me actually make sure I'm sharing my screen too. Sheesh, can't start these videos this late. Share your screen. Yes, share. Boom. Okay, so cool. Think you guys can see my screen on YouTube. I hope you can. All right, so live. Let me update this live real quick. What's up, y'all? If you got a question about the housing market, join me over on YouTube. Probably going to start in about 2 minutes. Dos minutos. Where's my thumbnail? If you guys got questions, drop them in the chat. I will get to them as soon as I can. Screen sharing is paused. So can you guys see my screen or not? Okay, yeah, you can see my screen. I know why I said screen sharing is paused. Okay. All right. Okay, cool. My bad, y'all. I'm gonna run a little bit late. So I'm about to just start right now and just jump right into it. Where are my slides at? Boom. Okay, awesome. Thank you for joining me on this Tuesday evening. We kick these off every Tuesday at 8 p.m. Eastern Standard Time as a part of my group First Time Home Buyer School. Click the link down below to join First Time Home Buyer School. You'll get to actually select the topic. If you, for whatever reason, don't want to watch on YouTube, you can listen to it on the podcast as well. I do a separate episode on the podcast breaking down this as well. So let's get into it. Going to analyze Fannie Mae's October housing report and tell you what the report says, and then kind of give my thoughts on what's going on with the housing market as well. All right. So sorry, I just put this slide on here right now because I was like, folks probably don't even know who Fannie Mae is. So, and why I think this is a very interesting housing port to look at. So, and this is actually news to me. I just know Fannie and Freddie as folks that actually just buy loans to help with the liquidity in the market. But this is basically for Fannie Mae's website. This is like their who are we. So chartered by Congress in 38 to provide a reliable source of affordable mortgage financing across the country. And basically what they do is, so you have a bunch of lenders out, right? And so when someone gets a loan, like someone gets like a $300,000 loan, right? So when someone buys a house, like the lender pays person X that they bought the house from like $300,000 at closing. And then you person Y who got the loan, you pay back the loan over the course of 30 years or 15 years or whatever, right? And so a lot of smaller lenders, they don't have the liquidity in order to give out all these loans. If they're having to front, $300,000 and they get it on the back end over the course of 30 years, they would kind of like shut down the housing market when it comes to like lending. And so like your big banks, like your Chases, your Wells Fargo's, your Bank of America, they can do that. But like your smaller lenders, pretty much everyone else, they don't have the money in order to handle all these loans. So what happens is like Fannie Mae, Freddie Mae, and other what's called like GSEs, government sponsored entities, they actually buy these loans from smaller lenders, and it helps with the liquidity of the market. So now the lenders can make more loans essentially. And so they don't like do loans originate, and they're supposedly a good, reliable source of financial information, as they say on their website. All right, and so this guy right here is the chief economist of Fannie Mae. His name is Doug Duncan. And so I'm going to read some quotes from the report that Fannie Mae dropped. And so I like to put these quotes on there because I like to, one, just give you information straight from the source. So like I'm a person just like you. I have my inherent biases as well, but I try to provide you the information directly from the source so you can kind of form your own opinion as best as you can. I mean, everyone's opinion has some sort of bias, even good old Doug's, right? And so what he had to say was basically, at times the market has reacted to incoming economic data. The Fed is making progress in this fight with inflation by anticipating potential policy pivot towards a less restrictive regime, prompting the Fed to restate its overall results. I'm not going to read the whole article or the whole quote, but what that says to me is, election year, I guess it's not an election this year, but next year, election cycle coming up. So the Fed is like, hey, we know what's going on with Biden. We don't know who may be in office the next quarter. So we're trying to get our ducks in a row now, essentially, and get everything, in theory, good to go. In case there's like a regime change, and then there's a whole different type of policy going on. So they're like, hey, the Fed is trying to basically fast forward this thing because they know Biden, but they don't know if Biden's going to be there in 2024. If they don't know, like some, I'm not even getting to who may be there in 2024. Right? Do your own math there, or how crazy that may get. And so as well, another quote there, looking ahead to the full year 2023 on a national basis, we expect an average home price decrease of 1.5%. And so, given the ongoing tension between potential home buyers and home sellers at the moment, we believe the pace of sales is likely to further slow too. And so what does that mean? So when they're talking about the tension between home buyers and home sellers, right? What they're saying is that, so I'm a homeowner, right? And I'm looking to sell my home. And in January, someone was telling me my home was worth $500,000, right? And now you're telling me in October, my home is worth $450 or $470 or something like that. I'm like, one, okay, I'm just not going to sell the home if you're trying to lowball me because we're in a market decline, seller. And then the seller's like, or the buyer's like, hey man, your home may have been worth $500,000 in January, but also rates were 3% in January as well. So like, I'm being killed too, right? So that's what they're talking about, like this standoff or this tension between buyers and home sellers. It's like sellers are like, hey, my home is worth more. Buyers are worth, okay, it may be worth more, but I can't afford to pay that price now that rates have gone from 3% to like 6 or 7%, right? And so that's kind of that standoff that's going on right now. And so that's impacting the housing market from a bunch of different aspects. Overall, the goal of increasing rates is to reduce the folks' ability to buy homes, which would, in theory, decrease the prices of homes, and in theory, trickle down and help with inflation. That's apparently how that stuff works. All right. And so this right here is a very it's a very important chart when we talk about what's going on with the housing market. So this is like year over year appreciation or depreciation for the housing market. And boom, so let me break out my highlighter or my laser pointer. Oh, it's red. Okay, why does it change colors? It was green last week. Okay, cool. Red is cool. I like that neon green though. That's kind of like my theme colors. And so what quarter are we in right now? We're in the third quarter of 2022. So basically all this data from here back is just historical data. So that's not a projection or a guess. That just is what it is, right? And so if we look at the start of the year, home prices were going like that, right? And so 12%, 17%, 19%, 18%, 20%. Oh, sorry, this is 2022. Okay, so I was like, this seemed to be going up quicker than I thought. Well, this is 2021, right? So 2021 home prices were just going like that, right? And then so when we hit the beginning of the quarter, that's when I think home prices, I saw a number where home prices were up like 43% like year over year. And so this is like the peak of the market right here. And so what has happened since then, as you probably know, we'll see in charts later in this presentation, rates went like this as well, which kind of tanked home prices to some extent, right? And so home prices went zoom, doom, doom. So they went up the roller coaster and they're coming down the other side, right? And so one like misperception that I see a lot of folks talk about that just kind of read headlines is just because home prices were depreciated or decreasing and like home prices were being marked down, that didn't mean they were actually depreciating, right? Because if you buy something for $1 and then the price goes to $2 and then the price goes down to $1.70, right? I guess it declined from the peak of $2, but you're still up from when you bought it for $1. And that's kind of how like appreciation works. Like stuff can go down and still be up at the same time, right? And so, but they say what comes up must come down, apparently. And so like normal appreciation in any housing market is like 1 to 4%. The last 2 years were just like a wild blip on the radar for various reasons. And so this one where like historically, like I said, 20 this year, third quarter. And then so from here on is what the Fannie Mae is basically projecting based on their data, their number crunchers and all that, is projecting where they think home prices are going to go based on a bunch of information as far as like home sales, obviously past home sales, what they think interest rates are going to be, what do you think unemployment's going to be. They're crunching a bunch of numbers in order to kind of get to this point right here. So I always say everyone's entitled to their own opinion, but like I always say, like, where are you getting the data to form your opinion from? And so if it's like the lunchroom, right, or the it's probably not as reliable of a source as like where Fannie Mae is getting their information. So all right, and so like next quarter we're still expected to be up 9%. That's October, November, December, and then still the beginning of Q1 2023 we're still expected to be up like 3%. But then boom, this chart is flipped, so we're in the negative area there, right? And so it's looking like somewhere between 1.3 and 1.5% appreciation in the last quarter of 2023. And so this is actually the first time that Fannie Mae has actually said that, hey, we think homes are actually going to depreciate. And so they put out this depreciation data like once every quarter. And so they the last one was, I guess, in July, however that works, whatever that last quarter was, right? Or June, July timeframe. And so they were like, we think home prices are still going to be up about 1 to 3%, which once again, 1 to 4% is kind of the norm for home appreciation if you look at just historical data, right? And so, this kind of vibes with like what I thought and what I was seeing with the housing market. And I say kind of vibes. I mean, I still thought that we'd probably be like a positive, like 1 to 3% based on what I've been seeing. But the big change in like the data that Fannie Mae is analyzing, kind of what I've seen as well, is like the Fed just raising interest rates at such a meteoric rate, right? I don't think anyone anticipated rates going up to 6 or 7%, especially like so quickly. And so let's go on to the next bit of information. I think there's just okay. And so once again, they originally predicted like 3.3% appreciation all the way through 2023. And that's before like the Federal Reserve raised interest rates so quickly. And so spoiler alert, I've talked about this, I think, on like every time I've gone live with you guys, but there most likely be a rate hike in November 2nd when the Fed meets again, 75 basis points. So if I know that, that, lenders know that. So typically they've already kind of baked in these interest rate hikes into their lending. But they always throw in a little bit more into the rates as well. Because what are you going to do? Pay for a home in cash, right? And so another quote from here. It said basically, so beyond diminished affordability, as mortgage rates continue to rise, we suspect the lock-in effect, as existing home borrowers have rates that are well below the current market, and is limiting the number of move-in buyers, right? So, folks want to kind of, move up, when they get in a better financial situation, they get a raise, or maybe they're moving for whatever reason, but that's kind of go by the wayside a little bit, right? Because if you're like, hey, I bought my home, whether it's in 2020 or 2017 or 16, and you're like, hey, my interest rate is it like 3 or is it like 2 to 4%? And you're looking at rates right now and just like, I'll probably just stay where I'm at for the time being. And so rates kind of chill out, right? And rates aren't expected to chill out until probably sometime around 2024, just kind of FYI. And so that's reducing some of the inventory on the market as well as far as existing homes. And so we know like basic economics, supply and demand. And so the demand is decreasing, due to the rates going up, but also the supply is decreasing as well because homes aren't going on the market, because folks are like, hey, I'll just sit in my house if rates are going to be at 7%. All right. So right here, here's a chart of like projected forecasted home sales right here, right? And so I was looking at this chart a little bit earlier. I was like, I don't know what is going on, but this blue is existing home sales, and so it's using this y-axis right here, and then this is just this x-axis, or this right here is new home sales. It's just not using any axis at all. I guess the axis would be on the other side of the chart, like over here somewhere, but there really wasn't one. And so important to note, like the important thing to take away from here is that folks are still like buying homes. I think like a common misperception is that, hey, because like rates are at 6 and 7%, like somehow folks are just not going to buy homes. Like no one is ever going to buy a home. No, like folks are still buying homes. As I always say, unemployment is truly what drives home prices, because if folks are financially stable, like they're going to buy a home. Just the rate is whatever the rate is at the current time. There's a bunch of different like creative things you can do as far as having your seller buy down, or the seller buy down the rate for you and do all this or that. So yeah, folks are still buying homes. They're just going to buy homes potentially at a lower rate than they did this year, the last couple of years. So the information from Fannie was just like the last 2 years, right? And so we look in 2020, we're at basically 5.6 million, 2021, 6.1 million, and then 2022, a little bit over 5 million, and then 2023, they're projected to be below 4 million essentially. And so I was like, okay, this is good, but like I always say, hey, what is it in relation to? Because you always want to compare the numbers to something, and this is like a historic blip on the market. So I went and found some data on like where home sales were the previous years, because I'm like, is this high? Is this low? Well, I know it's not low, but I'm like, is this super high? So is this 4 million a normal number, or like what's the deal? And so I got this next chart for you guys and gals. So this chart I got from Statista, Statista.com. And so this is just a chart right here, just showing you like historically, like where home sales have gone as well. And so once again, let's jump back. So in 2020, we're like 5.6 million. And then, and so 2018, 2019, we're like basically 5.3 million, right? And so if we jump back to where we're going to be this year, yeah, that definitely is a lull as far as, the demand for home prices going, or the demand for homes in general going down, because we're just below 4 million. And the last time we're in that 4 million number was, 2008 timeframe. But please don't run with this information like, it's 2008 all over again. Please see my previous presentation from like 2 weeks ago, why this is not like 2008. There are a bunch of different factors that are definitive why this is not 2008. But the biggest one in 2008, like home prices dropped 19.7%. This projection is saying 1.5%. But yeah, 2008 is the last time like home sales were potentially this low. And then so there you go. Once again, just comparing the time frames, right? All right, so what do we got next? Some more quotes from good old Dougie Doug. So with mortgage rates resuming their rise following a midsummer pullback, resulting in rapidly diminishing home purchase demand, we expect home prices to continue to decline in the near term, right? Because homes, and once again, home prices going up at the pace they were, and then rates going up at the pace they were, they're just unaffordable for people. And it's also kind of like just like a sticker shock, for lack of a better term, when it comes to folks being like, man, rates and home prices are going up this quick. I'm just going to sit on the sideline and not do anything. But I will say this, I'm not telling anybody to buy a home at 6-7% interest rates, but please believe rents are going up as well, because once again, supply and demand. So same number of homes to rent, there are less people that can buy homes. The demand is going up, supply is staying the same. So just some food for thought there. Because I remember like I saw this article like Miami, I think rents went up like 41% one year. I was like, sheesh. And they ain't coming down, those rents. All right, so let's see what Fannie has to say is going to happen with interest rates. All right, and so once again, we can kind of see what happened the last 2 years. Once again, this was kind of like the bottom of the rate market. I think this is interesting to look at as well, because a lot of times folks talk about, hey, rates were in the 2 and 3% threshold. I mean, they were in the 2% technically, but like 2.8, 2.9, they were in the high twos. Like folks to make it out to think that like you could get an interest rate of like folks are getting like 2.00s and 2.1s and all that. Some folks did have low rates because these are just an average, but no, average rates were like the 2.8, 2.9. So essentially 3%. And rates have really never been in the low twos ever, and they won't be in the low twos anytime soon. So don't bank on anything like that happening ever again. So I have another chart that's going to show like rates historically over the last 25 years. But so getting back to this information from Fannie, right? So their projection is, rates are here, but like they're not going down that far through the next year. So just kind of food for thought. Like I kind of showed you, the Fed is expected to raise rates or the cost to borrow money in November. So like they're going to keep rates up until folks stop buying stuff and inflation is under control. So that may take a bit. All right. Okay, so that was the information from basically the report from the from Fannie Mae on basically what is going on with the housing market, what has happened with the housing market, and what they project to happen in the future. So now these are some old slides I have from previous presentation. I know there are new folks that funnel through every presentation, but I just want to go over some 4 charts that show you data over the last 25 years so that you can kind of get a big picture perspective on what's going on. And so, this right here is the Fed fund rates, and we talk about the Fed raising rates. This is what they do is they raise the cost to borrow money. As you can kind of see, money was dirt cheap in the early 2000s. They raised it recently. You see that's like a huge quick spike right there to borrow money. And that's where right now, that's why rates are so high, because it costs lenders more to borrow money. So they pass that on along the year. Once again, this just rates over the last 8 months. Sorry, I thought I took this slide up. Okay, historical data. Okay, well, this is what I meant to show. I thought I took those slides out. All right. Okay, so yeah, if we look at interest rates over like the last 25 years, right? Boom. So we are high. We're definitely high, especially compared to like the last 20 years. But this time frame or this area right here, like this 4% threshold. That's why I say like an average, a good rate typically is like in like the 4% area, right? That's where we can kind of expect rates to get back to when we're talking about, hey, that's a good rate. Once again, that 2-3% thing is sayonara. That thing is long gone. And then we talk about home prices the last 25 years. Once again, this is why I say home prices always go up. This right here, 2008 housing crash, home prices went like that, but look where they're at right now. And they've just kind of gone up pretty steadily the last 10 years right there. And then right here, the last 2 years, they just went up like that super quickly. But home prices may come back down like this. Even if they come back, they won't come back down like this. But even if they come back down like this, right? They're just going to go back up like this eventually. That's just how home prices work. I mean, all the data in the world, you can see that. But folks will think that somehow home prices are, I don't know, go to zero, some nonsense like that, like just free homes. All right, housing inventory the last 25 years. So as you can kind of see here as well, inventory, even pre-pandemic inventory was decreasing already. And so we're slowly building back up housing inventory here. And once again, unemployment the last 25 years as well, like this is the factor that drives home prices the most, is actually unemployment. And so obviously this was like COVID right here. This is kind of crazy unemployment, even higher than the global financial crisis in the early 2000s. And so right here, unemployment is still relatively good. And so unfortunately, like I think the Fed is trying to drive, when they're driving rates, it's going to cause more for companies to borrow money. They're going to lay off people, and that'll kind of drive the unemployment rate, unfortunately, which will also contribute to home prices declining. So I think this is my last slide. If y'all got questions, okay, one more slide or a couple more slides, I think 2 more slides. And so this right here, just another interesting chart I'd like to show you guys as well. household debt service payments as a percentage of disposable income, right? So we're still at historic lows right now for people that are using their personal income to pay off debt. So like, despite what headlines might tell you, like the economy is not in the shambles you may see, even though we're like apparently in a recession, depending on who you ask. All right, cool. So if you got any questions, you can drop them in the chat, throw it up an X, and I will answer your questions so I know it's coming. You can follow me on these social platforms as well. Join my first time homebuyer school. I let the folks, for the most part, pick the topics for these sessions, and you can check out my podcast. All this stuff will be down the bottom, so you can get your home buying information on the go as well. So cool, y'all. Thank you for joining me. If you got any value out of the presentation, feel free to like the video. That boosts my morale and helps the information get out to more people. Once again, if you got questions, feel free to drop an X so I know a question's coming. If not, I will kind of log out of here in a bit. All right. And so this is kind of on a time delay, so I'm just going to sit here for a few beats as well, in case anybody has any questions. So cool. I will start my countdown for questions. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. Okay, cool. No questions. I appreciate you guys. Once again, feel free to like the video on your way out. That boosts my morale, definitely. And it helps the video get out to more people. So I do more presentations like this because I know what the people like. If you didn't like the video, I guess you didn't like it. You didn't like it either. So it's all good. So I will be logging off of YouTube right now.